Hey everybody, welcome to episode 9 from Property Investment Advisory with our live streaming on the 29th of April, I think, Donna, aren't we?
Almost there at the end of the month.
So we're got with us a special guest all the way from Queensland tonight. We have Donna McRae, who works for Golden Arrow Finance, and we also have our famous compere, Tony from AV Chartered Accounting. So without further ado, I'm going to hand you over to Tony so he can compare, which is what he does really, really well.
Thanks, Roger. Famous for all the wrong reasons, of course.
That's it.
So we are talking about mortgage brokers tonight. So all around the acquisition of property, we're talking about. We've been speaking to other people about the whole process around acquiring a property. So one of the most important parts is to actually get the money to borrow. So Donna, I'll start off with just a simple question around mortgage brokers. It's an industry that became more and more popular in the 80s. What is mortgage broking, and why would someone go to a mortgage broker rather than actually trying to go to a lender directly themselves?
Yeah, good evening, gentlemen, and everybody else. Mortgage broking, as you say, has become very popular in the last probably 25 years. What it's given clients is the opportunity for more options. Not everyone fits in the same box, so walking into a mainstream lender may not be suitable for all borrowers. So it just gives us more options to offer better products or more suitable products, and help people out to get into their own homes or their investment properties.
So I'd imagine that a mortgage broker can sort of, what I say is you can see the whole kingdom. So, if you walk into just one particular bank, those people have only got their products and probably their subsidiaries products, and that's it. Whereas you guys can sort of stand back and see everything that's on offer, which then allows you to, I would imagine, tailor a loan specific to that individual, mum and dad or that individual person.
Yeah, that's exactly right. So we look at it as the best interest of the client. So we need to look at a whole suite of lending products. Look, there's many lenders out there now, more than you can almost count, and being accredited with all of them isn't just about possible. But you can certainly find different lenders to fit different requirements of individuals.
Yep. I want to unpack that a little bit further, because everyone's familiar with the big banks, the Big Four, and then you've got St George, and you've got a few of the other small. Tell us about the second tier lenders. Some of these lenders that we may not have heard about. I don't know, we've heard of Aussie Home Loans and all those ones, but some of the second tier lenders, my understanding is some of them are getting a real foothold in the Australian property market, and they're starting to make a real impact and starting to dent some of the figures for the bigger guys.
Yeah, that's true. I've come out of the big banks, and some of the lenders that the names that crop up, and you're going, who are these guys? So there's a real opportunity in that sort of second tier area, that for people that have got maybe bad credit history, or things that are just not that a major would be able to contemplate. There's those other opportunities out there for people that haven't actually got the right fit for those bigger companies, So there's we've got the Peppers and the Kudos and Oswald, and there's a huge range of other options out there for us.
So I'd imagine that their interest rates are a little bit dearer, the upfront application fees would be a bit dearer, but with so many of them in the market, I imagine that they sort of level out because of competition. Yeah.
There's a couple of ways of looking at it. So lenders will price for risk. So if there is a bad credit history, then fair enough. You're taking the lender's taking that risk. We're going that little bit higher. So there will be pricing changes in there that will reflect that. Sorry, yep.
Well, I was going to say, what happens, like, if you want to get somebody on a good loan, but they can't start with a good loan? What would be a sort of advice to, now and into the future?
Well, so in a situation like that, we'd try and get them into the property, whether it's a suitable lender that's in their best interest, and then just say to them, if either we have good behaviour for 12 months, 2 years, we can go back to the lender and negotiate a better rate, or we can take them to a more mainstream lender that
renegotiated
that may have a better rate. Yeah, so it's that has happened a couple of times in the past with my portfolio, and it's nice to be able to get them, away from that maybe slightly higher rate and get them into something a bit lower, and they're quite grateful.
Yeah, absolutely. Donna, I'd mention that you'd come across this scenario. I come across it a fair bit as an accountant. So there's two types of clients. The one that rings you up on the Monday and says, I've just bought a property at auction on the weekend. I need a loan in 4 weeks. It's about to settle. And of course, they come to us and say, I need financials and our tax returns in 4 weeks. But the ideal client, going the other way, where they actually come to you first. Let's talk about that perfect scenario for you as a broker. What's the best way for someone to approach trying to borrow money for a property?
So certainly I would ask anyone out there listening to go and talk to your broker or your lending bank to get a pre-approval before they go anywhere near an auction. My advice to all of my people that I speak to is get a pre-approval first, and then be very careful if you do go to auction. So there's always risk. There's always risk of not being able to. The simple thing is that the property might not value up. If people get excited at an auction, it could go well over the actual value of it. So I'd just ask people out there listening to go and get a pre-approval underway before going, and even going, making a conditional offer. I don't know what it's like down where you guys are, but there's a certain amount of pressure on the market here, and 20 between 14 and 21 days, we'd be pushing to get finance approval.
Yeah, right.
And our settlements are normally 30 days.
Cool. I was just going to ask around this concept of lending value, which is something that I don't think a lot of, even when I sit down with clients and try and explain the simple concept about, there's a price of a property, but then there's a lending value. There's an amount that a financier is going to go to and really doesn't want to. Do you just want to explain a little bit more about what that means and how people really need to understand how that is really very, very important when they start to borrow money and buy a property?
So what we call loan to valuation ratios, LVRs is our term that we use. When you're buying a property, there is the amount that you're prepared to pay for it, and 99 times out of 100, it should value at that amount. There are risk factors, but it should value to that amount. So the ideal client or the ideal position is 80% loan to valuation ratio. Most lenders will do that subject to servicing the debt. They'll do that, every time, most times. But you can go up to as high as 95%, including what we call lender's mortgage insurance. So anything over 80% and up to 95% usually attracts lender's mortgage insurance. Some of those other lenders that we were talking about before, they call them risk fees. So it all comes down to the mainstream lender's mortgage insurance over 80%. And that's calculated depending on... You go. That's right.
No, you go, mate. I cut you off, so you go.
I was just going to say that it all depends on the lender as to how much those fees they can change. So you might have a lender that might charge $10,000 for the lender's mortgage insurance, and bear in mind the lender's mortgage insurance doesn't cover the client, it covers the bank.
Yeah, so that's what I want to I sort of want to make it really clear before we move off this topic. Yep. So that everyone understands. So it is an insurance policy that the bank takes out against you defaulting, and if you default against the loan, they then go to the insurance company, so the bank are covered, and for the privilege of taking out that policy, they actually charge you for it. So you're going to pay an extra $10,000 up front for the privilege of going beyond 80%.
So
that has been just one of the things on that. One of the incentives that have come out from the government, though, is that first home buyers, it's limited as to spaces, and a lot of the spaces have gone, but they have provided some of the lenders with guaranteed up to 95% no lender's mortgage insurance chargeable to the clients. So those spaces are like hen's teeth now, I think. But they were
Up to
was
95.
very popular.
Wow.
Is that something out of COVID that came out of the whole sort of pandemic, or is it
Yeah.
So just a question I've got that probably both of you could sort of answer, just so that, because it's, I sort of knew the answer, now I'm a little bit more grey and fuzzy with it, but with regard to investing, what is the rule of thumb that, as far as mortgage insurance is concerned, like, you know, if you've got to go and save another 50K, that might take you another 3 or 4 years and you may have missed the market, you know.
Yeah.
But the other side of the coin is that from a tax perspective, what can you claim as far as the mortgage insurance, and has the rules on that changed more recently, I guess, is the...
I might take that one. Mortgage insurance is just part of the borrowing costs of the property. So if you had to pay, you know, broker and valuation fees and, pardon me, a lot of those upfront fees, any fee that you have to pay in order to borrow the money.
Yeah.
The rules are that if it's still more than $100,
Yeah.
the $100 I think was in place when I started work in '82. They never indexed it.
Yeah. So I wasn't saying well for that.
If it's under $100, you can write it off. You can write the whole amount off.
Yeah.
It's never been indexed, but if it's over $100, you write it off over 5 years or the term of the loan. So as soon as that loan's renegotiated, whatever the balance is.
And so you can write it off over 5 years now. So if you pay 10 grand, you can write off 2 years,
2,000
$2,000 a year. Okay, all right. I thought it was put back to the end of the sale of the property.
No, it's not a capital item. It's a cost of borrowing. So,
okay, all right. There you go.
So Donna, you have your perfect client, and they don't go out and buy a property at auction on a Saturday. And they give you a call and just want to know about their borrowing capacity. What sort of information do they need to package up and get ready for you to bring in?
I think the most important thing, and I've shown Roger this, we've actually got a portal that we can share with them. All we need is their mobile number and their email address, and they can input their expenses, their income, and give us an idea of what they want to borrow, and what their savings are, and we can do a comparison at that point, just a really high view one, and give them an idea of what their capacity to borrow is.
Living expenses is a really interesting. Yeah, absolutely.
Yeah, I'll just take you back a step when you're talking about fees. So with a broker, some brokers will charge an upfront fee to the client. Mm-hmm. It's not something that I do, but we're not paid by the clients. We're paid by the bank on settlement. So we don't get a cent until the deal actually settles. So I just wanted to clarify that. Sorry.
Yeah, absolutely, and keep going on that. So back in the old days, there was a trailer. So you got paid throughout the term of the loan. That's all changed now as well. So is it just a fee, one-off fee, and you don't get any trailers?
No, there's still a trail.
There is a trail.
It's a lot less than it used to be, isn't it?
Yeah, they've cut.
Yeah, it's a lot less.
I've heard on the grapevine they've cut a lot.
It used to be. I used to think it was. Well, when I did it, and this is 15 years ago, just Donna might want to buy a property.
There were no portals back then.
It's 0.6% for the lump sum.
Wow.
And 0.25% trail was the going rate. So.
Yeah,
back in the day.
They differ, but yeah, that's probably fair.
Okay. Yeah, fair enough.
So let's get back to
we haven't had a pay rise in 15 years.
Yeah. Well, yeah, I know that a lot of the lenders at the banks look at you and go, well, you know, you can do this a lot more efficiently, so we'll cut the amount that we need to pay.
The loans have gone up, so there's your pay rise, Donna.
Yeah, that's it. Yeah, the dollar value's gone up.
Thanks, Roger. I knew you were on my side.
That's it. That's it.
So getting back to the living expenses now, I don't remember having clients myself ever having to give a bank or a broker living expenses 20, 30 years ago. That's something that seems to have come in probably the last 2, maybe 3 years. Now, just give us a little bit of background on that. Did that come out of the Banking Royal Commission?
No, it's before that.
All right, okay.
Yeah, it was definitely before that. So it's been in, as you say, probably, I don't know, several years, probably maybe 3 or 4. And it has had a huge impact. I mean, you know, when we first got our loans in the 80s, when the interest rates were 17%, we would cut, or 18% or whatever, we would cut our expenses to pay our mortgage, you know. But that seems to be, there's been a bit of a change in that people are asked to provide, what they spend on groceries,
That's
outgoings
ridiculous.
for rates, and it's quite a comprehensive list of
It's very intrusive.
outgoing.
Exactly. Who would make the decision on they should have bought from Woolworths instead of Coles, or in what they didn't really need to go and get the chocolate bar at the end? Who makes the decision?
I don't know whether they
on
make those decisions, but I know one of the things that, and Donna will confirm it or otherwise, but I'm pretty sure the banks now want to see about the last 6 months' credit card statements. So they'll see that you go to, we're creatures of habit, so we'll go to the same petrol places, the same Woolworths, whatever, along the way. So there's no point telling them that, we spend $100 a week on groceries when the credit card shows you're spending $300 or $400 a week. They'll pick up on that pretty quickly.
Yeah, so there's actually bank statement systems now that can go in and pull out the bank statements for the individuals, and they actually show the amounts of what you spent for groceries, what you spent on related. So you can't hide. But it's not
correct.
6 months. It's not 6 months. It's 6 months on a bank statement, loan statement. Sorry, if you're refinancing. Normally, it's around 3 months. The last 3 months is a real guide. And I think some of the idea behind that is we want to see 3 months genuine savings as well. So we want to see the behaviour changing or showing that you're putting that money away as well as your expenses.
Is that for your first homeowner? Is that for your first homeowner, or was that for everybody? Genuine savings.
Genuine savings, first home buyer. Because generally your second home will be equity.
Yeah.
I know exactly what you're talking about, Donna, because I borrowed money recently to buy a property, and I hadn't borrowed money for a long time. And we had to use this portal where it actually, you logged in, you told them which bank, the BSB and the account number, and all your accounts came up. You had to click on the ones that they wanted, and all of those bank statements, were automatically sucked up in the portal. I can only imagine that the reason they do that, A, to make it more efficient, but also to counteract fraud. Would that be a fair statement? So people aren't sort of, manipulating bank statements and changing things?
Yeah, pretty hard to, mind you, sort of I'm not that deceitful, but pretty hard, I would imagine, to change your bank statements when you really have got to show that those 3 months, and one of them's got to be a formal statement. So it can't just be a transaction listing.
It used to happen in the 80s. You're talking about the 80s.
What didn't happen in the 80s?
Well, I was going to reference Alan Bond. I remember Alan Bond borrowing money in the 80s. It was a phone call, and he borrowed, I think it was about $11 million unsecured. It was one phone call. It was extraordinary stuff that came out at the time.
I wouldn't be able to help him.
Can you do that these days, Donna?
No, I wouldn't be able to help him.
We'll pay it back. Donna, what about... So if I'm out there, and a lot of the world's online at the moment, what is the difference between going to you to get like a borrowing capacity and just going online and doing that? Like, why would I go to a broker and not just use an online facility?
Well, I mean, it's up to an individual, but you probably find that a lot of people want to actually still have, rather than talking to a computer and not actually getting 100% correct. Not that I'm perfect, but just the opportunity to be able to speak to someone rather than just doing it online. Mind you, I'm older generation, so that would be what I would do.
Are they accurate,
a lot of my clients are younger. Fairly accurate. Fairly accurate. The thing is that we delve into a lot of stuff before it actually goes to the lender. So if there's anything we understand from the experience that we've got over 30 plus years. So we know what the banks are looking for. We know how to present it. If they make a mistake on one of those platforms that you're talking about, and that actually gets to the lender and they haven't actually done it correctly, then there's that risk of going, no, sorry, declined, and you don't want that on your credit report now either.
No.
Because once they press the buttons, and this is the way I understand it, and again you confirm or otherwise, once a lender actually rejects an application, everyone can see that. The whole kingdom can see, or other banks can see that, you did apply for a loan 6 months ago and you were rejected.
Yeah.
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 What are the
So
rules
anything
surrounding
that-
that?
a lot of- just go back a sec with the. They can see if you've applied for a credit card. They can see, so you can't actually hide from that sort of stuff either, because the credit report will outline it all for you for the lender. Sorry, Roger, I interrupted you there.
Oh, no, it's all good. You answered the question anyway. So.
I don't sort of carry any sort of grudges or anything, but when I was 17, the ANZ Bank knocked me back on a $500 credit card. I got over it, but if that's on my credit report, hey,
that was a lot of money.
It was a lot of money back then, and gee, considering I was a young accountant back then, they really could, there was a lot of foresight, on the future earning capacity of the person who was in front of them.
That's probably.
But I got over it.
Well, you turned out right anyway.
Yeah, I wouldn't loan me $500 when I was 17. Donna, I want to ask you about a sort of a new, I won't say it's a new phenomenon, but relatively new phenomenon. We all know property prices are increasing. We all know that the next generation are finding it incredibly difficult to get into the property market. So I'm starting to see a lot of parents who are coming to me for advice on trying to structure a house purchase for their children. So what are you seeing around the sort of mum and dads coming in buying to try and buy something for the 19, 20-year-old, and specifically around guaranteeing of loans and whose name the loans are in? Are the parents still taking the risk and putting the loan in their name, or are they putting in the name of junior and going guarantor, or sort of the? I've got an Italian background, so I can say this: the ethnic model that let's all buy a house together.
We buy another one, they move in, and you buy another one, they move in.
Grandmother comes along as well.
Yeah.
There's certainly some options out there. ANZ actually, if I'm going to throw something out there, and their guarantees to you.
Please.
You shouldn't brought ANZ up, but they're pretty good in the guarantor space. I've just recently got an approval through them for a guarantor loan. There's another thing called a share loan too. That so I don't see a lot of guarantees. And when I do, I often, well, you have to anyway, but just sit down with the parents and just make it so clear about their risk, and it is getting harder for the younger people. But the other option is a share, and it's one of the lenders does it, or maybe two, where you could have two friends, for example, that want to buy a house. One's got more deposit than the other. So they're both still on title, but they could be a loan for a different amount. So it's not a guarantee. It's like a share loan. So
like
that's
70-30 or something like that, isn't it?
And they're separately. They're not joint and severally liable. They're responsible for their own percentages.
That's correct, of the debt.
Right. Cool. Very cool.
Never heard of that.
I can send you some info on that. I'll send you that info, Roger, if you want it. So
yeah, that'd be good.
So back in the old days too, Donna, where interest rates were a lot higher, and you mentioned 17% back in the 80s, and even when they were sort of 8 and 9%, we as accountants, you as a broker, were asked all the time around what sort of loan structure do we set it up as a fixed interest? Do we lock in 5 years, or do we take the punt with a variable loan? What are you seeing in the last couple of years around the trends of locking loans in for fixed periods of time?
There's a huge shift in actually splitting the loan. So
right.
Let's say $500,000, have an offset account linked to the variable portion. So you have your wages and salary. Any small businesses might have their excess funds running through that. Say you have a limit of 100,000, and then fixing the 400 for 2-3 years, something like that. Still, you can still normally take $10,000 a year off the fixed rate as well, but you've got that smaller figure on the variable rate, which you can attack if you want to drop it down. And we see that a lot actually with your guarantors. That would be something that I would suggest considering for if it was going to be the children borrowing. Maybe put the variable rate of the 20% or whatever it is that the guarantee is, put that
Yeah.
on, actually on a shorter term. If they can afford it, put it on a shorter term and get that smashed out before, so that the parents can be released.
Donna, just on that, so one of the things that has changed more recently, I couldn't tell you the history because I don't know, but back in the day, you could guarantor both the loan and the income. Can you still do that today?
It's very few that do it.
Really? It's still
It
available though?
can be done. I'd need to check my spreadsheet, but very, very few. Very
Yeah,
few.
okay. I thought it was obsolete. But
Donna
Because
knows
it's-
someone.
Yeah. Yeah.
You know someone who knows someone.
that's it.
Going back to the splitting of the loans, again, I'm just curious, how do the banks do that? Is it still just one repayment that they charge, or do they charge a monthly repayment on the fixed portion and then interest on the variable? Do they split the
Yeah,
repayment
no,
so that
it's
there's
split.
it's split? Yeah.
So it's even though it's you might have 50,000 sitting in your $100,000 limit, you'll still pay the monthly payment to repay it off over
Gotcha.
30 years
Yeah.
because it's still that's the limit. It's not
Yeah.
what's outstanding.
Yeah. I think it's a great idea. I actually don't see that very often, the splitting of loans on properties. Is there a difference between when you would do that for, say, an owner-occupied property versus an investment property?
Sorry, can you repeat that because I lost you there?
Yeah. The question was, do you see a difference in the splitting of the loans option when there's an owner-occupied property versus an investment property?
Oh, definitely. So your owner occupied, you definitely look at that option of splitting. But you're the accountant, because, and I'm not giving accountancy advice, of course. But
You can.
you know, if you,
I'd
I
have
would
to be
I
good
would
with percentages.
I would consider referring. I'd definitely refer the client back to their accountant, but maybe when it comes to the investment loan, you want to pay your non-tax deductible debt off first. So you put it on the longest term possible, potentially interest only for the investment portion, and get rid of the owner-occupied debt first.
Yeah, I knew a person many years ago who absolutely refused to pay down debt. So he had an interest-only loan, and the term was, say, 2 years. And at the end of 2 years, he threatened the bank and said, "You either roll it over for another 2 years, or I'll go elsewhere." And he just kept doing it for the entire time that I knew him. He just kept rolling it over as an interest-only loan. What's the attitude with lenders and banks now with this? I'd imagine that at some stage they do want to see some principal and interest reductions, and they would stare some people down, like my old friend that insisted on interest only for his entire life.
So was that on a owner-occupied or investment?
Investment.
Yeah. So investment generally is 5 years, but if it's a fixed rate, it normally needs to be, like if you're going a two-year fixed rate. Generally, the interest-only period would be 2 years, but you still negotiate it, negotiate up to the 5 years. When it comes off. So
Yeah, so
generally
can you roll it again though, Donna?
That was where I was heading. Looks like she knows someone.
Same question, different answer, I guess. But yes, you could potentially try that with your existing bank, but there would be nothing stopping you going to a different lender to do it.
Well, one of the things that we often see, especially if people do like a 5-year fix at the moment, so they don't have to worry about the investment portion, that's a controlled cost, and they just figure out how they're going to pay the home loan down. But do you want to just explain what happens to, say, a 30-year loan term, Donna, with the fixed interest component, and when it goes to a variable rate, not a fixed, an interest-only portion, when it goes to a principal interest loan, what happens to the 30 years after 5 years? What does the rates change?
If you're going on to principal interest, the rates are normally lower than a interest-only loan. the issue that you've got with interest only is that a lot of the calculators that we use for serviceability will calculate the term over 25 years.
Okay.
So it affects your ability to service the loan.
Yeah.
I want to ask a question about serviceability. So I did hear some pretty horrific stories in the last 2-3 years around that. So interest rates, as we know, are quite low, so 4%, something like that. But a lot of the banks were essentially forcing people to prove that they could repay the loan if the interest rates were, say, 7 or 8%, something like that. Is that what's the latest on that? Have they sort of lowered their sights?
Yeah, they have.
Interest rates will never get back up to 8%.
They have brought their margins down a little bit, mostly sort of around the low 5s to the 6s.
Yep.
That's with us sitting at the moment. But look, it's prudent to do that.
Yeah, absolutely.
Because you don't know if you're taking out a 30-year loan, you don't know what's going to happen in 10 years. So you've got to be able to show that you're doing the right thing by the client. If rates do increase, then they've got the ability to repay it.
There's a book I read when I was young by Noel Whittaker, Making Money Made Simple, and he references the miracle of compound interest.
Yeah.
And I'll never forget the chapter. He said something along the lines of that when he was at school, he was learning the names of rivers and deserts and country capital cities of countries. Why did anyone teach me about the miracle of compound interest? So, and I've actually passed it on to my daughters and showed spreadsheets on just making one extra payments, how much of an impact that 30-year loan, it brings it forward by, almost 2 years.
Yeah.
It's just extraordinary. And I think one of the things that I love telling people is if a bank writes to you and says, okay, here's your minimum repayment of, $2,577 a month, round it off to $3,000 and just start right from day one with that mentality of just paying off a little bit extra
savings.
So you're ahead of the line. So.
Yeah, we always try to encourage our clients to get sort of ahead on their home loan as well as ahead on their investment. So if worse comes to worse, they've got a fallback option.
Yeah, absolutely. Donna, do you have an opinion?
Just be careful on the.
Yeah, sure. Yeah.
Just be careful on the fixed rate, so you're not paying any more than you're not going to be penalised.
Yes. Yeah. Cool. What are your thoughts, Donna, on when people do pay extra? Would you prefer to see them with a loan where the balance is $100,000, but they can redraw, $200,000, or would you prefer to see the extra amount sitting off to the side in an offset account?
Doesn't really matter.
Doesn't?
To me, it doesn't really matter. No.
You're not suspicious of the banks that turning around, taking the redraw away from people?
Yeah, there was circumstances of that recently, and they had to back down. So I don't think. Who
was that? Was it Me Bank or something? Who did that? Or?
I can't remember who it was, but it caused an absolute furore.
Yeah, I think it was Me Bank. It was changed from Me Bank to Them Bank after that. So
to Me and You Bank. I don't have any further questions. Do you have any?
No, there might be some of our viewers might be asking some
questions through. Alrighty, sorry, man.
Good.
Yep, I'm good. If I've borrowed 90%, this is Val from Hamilton asking, of the value of the property and paid mortgage insurance, is that a one-off amount or is it every year?
No, it's one-off at the start. It's one-off.
What if I change?
And it all depends.
Sorry, Donna.
So it all depends on the value of the loan, the loan to valuation ratio. So 10,000 is just a figure I've chucked out there. So don't take that as gospel. It could be a lot more.
It's pretty close.
Yeah. What if I refinance that loan 2 years later with a different lender, and it was still 85%? Would I pay mortgage insurance again?
Yes.
I imagine you would, because that policy is. Yeah, because that policy is for that bank. You have to then take a new one.
Unless it's the same mortgage insurer, you may be able to get a refund. So I avoid those. I just say you've already paid mortgage insurance. We're going to leave you there, and what else do you want to do? Because it's just not worth it. It's just too much money. The thing at the moment, though, to bear in mind is that valuations, it's probably worth getting a valuation before going down the track of saying, no, let's leave it alone. If we get a valuation and it's under 80%, then we can do what we like after that.
I do have a question on valuations. I might just save it for a little bit later. Are there any other question? Sue from Neath. If my house value goes up by 15% in 2 years, do I get a refund?
No.
Or just not have to pay it next year? Sorry, Sue.
No,
It's
not,
this is mortgage insurance again, isn't it? Yeah.
Yeah.
It's what we call a sunk cost. Once it's out the door, that's it. You're not going to get a refund from it.
One of the things in regards to mortgage insurance, though, is like I've sort of touched on before, don't always, especially with investing, don't let mortgage insurance get in the way of you actually starting an investment portfolio, because waiting till you don't have to pay mortgage insurance is sort of like, missing the tree for the forest. So,
there is that. And again, we'll stick with the $10,000 example, and I know what you're saying. Someone goes and buys a property, borrows 95%. The value of that property in the last 12 months could go up by 50 grand. So it's paid for itself. We've seen incredible increases in prices over the last 12 months. So yeah, it's if you can time your run in the market correctly, it's an awesome investment.
Yeah, it could go the other. Just to be negative, it could go the other way as well. So. Well,
you Queenslanders do tend to oversupply in certain areas, so you're quite right. All right, Dan from Red Hat has a question. If I save $5,000 and my parents gifted me $50,000, will a lender recognise the whole amount as a deposit? That's a great question.
It is a good question.
It is a very good question. If you pop it in the bank account and leave it there for 3 months, yes.
Oh, there you go. Didn't know that.
It's all that upload of bank statements. That's good. I'm going to change my pattern of behaviour on my credit card. I'm telling you now. My credit card over the next 3 months is going to completely change based on what Donna's just said tonight. It's an interesting one. That's what I was alluding to earlier around parents helping out the kids with a deposit for a house. Any other questions coming through? That's it. I was going to ask you a question around valuations and your experience in people going along and saying buying a property off the plan, or pick a figure, say 850,000 in southwest Queensland. The bank come back going, that's only worth 600,000. Have you seen situations where the banks have not been happy with the valuation has come in a lot lower than what the people have paid?
Yeah, so just on that, the bank will only take the 600 as when you're working out the loan to valuation ratio. So it's the lower of the two, purchase price or valuation. So that's a really important thing.
And then take 80% of that, so then it's 480,000 to try and buy something at 850.
Yeah, so that's just it's one of those things that if the valuers come in light, then they'll take the lighter figure. So what was your question again?
Oh, just if you've seen that scenario play out where people have locked themselves into a purchase at 850, but the bank have come out and said, no, we think it's only worth 600, we'll only loan you 480,000. So they've got this massive amount plus stamp duty and costs to come up with.
There was quite a bit of that a few years ago with the oversupply of units in Brisbane. So yes, I have seen it, but it's not as prevalent now. It comes down to the security where it is. Roger would probably be able to give you a little bit more feedback on that as well. But there's certain securities that might value, if they're considered specialised, then they might come in a bit less. So we've just got to bear that in mind when we're doing our calculations.
I'm waiting for someone to use the term greedy developer, but that hasn't come up yet. So.
Have some room to move, I think, is the whole key there. So
yeah, absolutely.
Yeah, be conservative with your borrowing, which is something we certainly take into account.
Yeah.
We've always got a 5-10% buffer.
Have plenty of margin. Yep. Yeah, and I think that's a real lesson for a lot of people too. I don't think there's enough margin in our lives in a lot of things. People just do things so close to the bone, and you're the one who's under the pressure trying to get loans across the line where things are so tight.
Yeah.
In a market such as this, though, what I've been finding, more recently, especially over the last month, is that property prices are actually hitting their values on the market, because the valuers are too scared to say no, it's not valued at that because the evidence is less. So.
There's a lot of demand. There's stock is the issue for a lot of real estate people up here. So
Yeah.
All right. Well, that's all the questions I had.
Yep. That's about
I'll
all
let
the
you
questions.
wind
Yeah. So look, thank you very much for all joining us, and don't forget to mention that there's actually no such thing as a poor question or a silly question. A question to ask is something for everybody to gain. The other thing is that episode 10, it sounds like a Star Wars trilogy. We'd like to first of all thank Donna McRae for joining us today all the way from Brisbane and helping us out with all the technology to get all that working, which is great. So thanks very much, and Donna, and talk to you soon, no doubt. And next time round for episode 10, we're going to have Damien Russell from Russell Partners. He's also in Queensland, and what Damien does is he does the property inspections. So he's an inspector after the fact. So once it's built, especially if it's in a state, sometimes it's hard for our clients to get to,
Yep.
and he does about 100-point check on the properties, making sure that they are everything is there as was in the contract, and not only that, making sure that the builders go back and fix all of the things afterwards. So that'll be
Cool.
great to have him on. That's the 20th of May, which
Look
is our
forward
next
to it.
live stream session.
And I guess one thing that I guess I was a little bit remiss of saying, that if there were any sort of Queensland State of Origin supporters that were listening, I'm sorry if we spoke a little bit too quickly, but we'll fix that. We'll speak a lot slower for you next time.
Jeez. Okay, thanks you very much, and until next time, thanks.
Take care.
Yep, cheers. Bye-bye.